everybody, Brian here from quantlabs.net. Today in this video I'm going to go over portfolio optimization over the last few days versus where we're at now. And we're going to look at the volatility and how it affects the expected return, as well as Sharpe ratio. Before we get started, if you like what you're about to see, just join at quantlabs.net/contact. So let me show you what we're looking at right now. Okay, so a few days ago, I put out a listing using these 5 assets. Okay, this is for like assuming, first of all, U.S. not so much in a positive sense for in forecasting based upon its daily data. But here we're using oil, British pound against the New Zealand dollar, pound against the Polish. This right here is the UK FTSE 100 ETF, and this is the ETF for Europe. So when we pass this through, you can see here's our volatility at 20.22, variance at 0.09. It's not very high performance. Now again, this is not to be exact. I've shown how I'm doing this on my previous videos using Pi Portfolio Optimizer package, Python. So let me just show you this further. Now this is from today's data, using 2 days ago, this asset mix. So here we are going to get 11% volatility annual, Sharpe ratio at 2.9, and expected annual return at 35.9. I think that's just due to oil. But when it gets more realistic here, what you'll find is the only short you would probably take if you could do it is the pound against these Lotley. But here you can see the annual volatility is fairly high. Expected annual return 100 and a ratio of 2.56. So we'll come back to this in a minute. But here's the new assets picks from today. All of these. And when you include them all, this is what you get. Expected annual return of 41%, annual volatility at 19, and a Sharpe ratio of 2. So when you take all those out, and you only focus on the longs, long only, so this brings it now down to, let me see here. So we have here Japanese against the US dollar, British pound against the Australian dollar, pound against the New Zealand dollar, and then we have here Taiwan, and again back to the UK 100. So we're not using any of the commodities. Now comparatively, does this change anything? Annual volatility will drop to 3.9, and the Sharpe ratio will be 2.23. So comparatively, the Sharpe ratio is still higher with the previous few days ago. And the volatility is 11.7. So when you compare that, this volatility just drops. Okay, using this. Okay, using again Taiwan, the UK 100, FTSE 100, and then the 3 pairs: Japanese yen, pound against the Australian dollar, and the pound against the New Zealand. So that's what we get. So continuing along, what I do here is I drop out one of these currency pairs, which is the pound against the New Zealand dollar. So in this case, we're left with Taiwan, UK 100, FTSE 100, Japanese US dollar, and the British pound against the Australian dollar. So here, these are our weightings right here. So our expected return is a lot more realistic, 10.8% versus, well, it's actually the same, and our Sharpe ratio is 2.28, which is a little higher since I dropped the which one did I drop? The pound against the New Zealand dollar. So we get a slight increase, sharp ratio. The volatility is the same, as well as the expected annual return is the same. But from a metric, as I said, the sharp ratio goes up slightly. Now I thought, hey, why not add in a US exchange, see what would happen. So originally I added the SPY and the NASDAQ. And again, these are ETFs. So here we have our expected annual return still 10.8, and that's why, because the SPY is at 0% allocation, which means it doesn't really affect it. Sharp ratio stays the same, and annual volatility. So again, this is analyzing and forecasting data moving forward. That's why we do the portfolio optimization. But the US at this point, these markets, US, do not really affect the forecasted sharp ratio, annual return, and volatility. Meanwhile, if you stay, and I keep saying, non-correlated, I put up an article about this on my the newer site, quant-labs.net. So again, when you look at, you've got Taiwan, which is nothing to do with US. We have the London, which has been performing pretty good. And then we have, again, Japanese and US dollar, which is a safe haven. And then we have pound against the Australia dollar. So there's not a lot, I mean, there is some correlation there, but not quite. And if you go into my article with that quant-labs.net, I could just show it for you. Maybe those for on the podcast. What we're looking for here is this article here, prosper from trading non-correlated portfolios. Lots of articles here on that, and there's a range that you can use of -1 to +1 to measure the correlation between all these assets. So what you want is, you want it to be, as I said, non-correlated. So you can refer to these articles. And again, that article's prosper from trading non-correlated portfolios. That's really important as we move into an era of not being able to depend on the US markets, which has been pretty well easy money, as they call it, and going into a rising interest rate environment. So that's why it's more important to look for non-correlated assets. Now also the digital currency, I have to use the words carefully here. I'm getting much better returns as of today, but that might be just today. But here it is, are the results. 92% win ratio, 2.7 returns so far. So that's where you're going to really get your wealth. But a lot of people don't want to partake in that space, which is fine. Doesn't bother me. It's not my money, right? As I like to say. So mainstream asset and allocation, you're going to get very paltry results. But here we're doing okay on doing it properly. And again, if you want to know more, go to quantlabs.net/contact. Get on our daily newsletter. Over and out. Thanks for watching.